Peace and greetings, peace and greetings. This is Korey Rose from YBN, everyone's favorite internet entrepreneur. And in this video, we're going to be talking about the basics of options trading. Yes, options trading. Everybody's been hitting my inbox, flooding my inbox with tons of questions about how to do options trading, how to leverage their money more than buying a traditional stock. So in this video, I wanted to break down the basics of options trading for you guys out there. So make sure to like, share, and subscribe to the channel for more daily information such as this one. As I said before, guys, what we'll be talking about today is the basics of options trading. And these are some of the topics we're going to be talking about today. So we're going to be talking about derivatives and options. We're also going to be talking about the type of options. We're going to talk about components and building blocks of options. Also the styles of options. We're going to talk about types of contracts. We're also going to talk about the risk in options. Then we're going to go over some basic strategies in your options plays. And then we're going to talk about when to buy and when to sell an option. And then lastly, we're going to talk about a little bit about the Greeks. Not too much, but just a little bit about the Greeks today. So once again, if you ain't subscribed to the channel, make sure to hit that like button. Subscribe for all types of financial information. So what are derivatives and options? A derivative is a contract between two or more parties. Whole value is based on an agreement upon underlying financial assets, index, or security. Common underlying instruments include bonds, commodities, currencies, interest rates, market index, and stocks. All right, that's a derivative. What is an option? An option is a contract which gives the buyer, the owner or holder of the option, the right but not the obligation to buy or sell an underlying asset or instrument at a specific strike price on a specific date, depending on the form of the options. So guys, I wanted to start with this because you need to know the difference between a derivative and an option. And the biggest difference is an option, the buyer who has the holder of that option has the right to, but not the obligation to buy or sell that underlying asset. All right. And a derivative is a contract between two or more parties. Okay. What are the usage of options? These are the three usage of options, guys. We're going to talk hedging. Here's the three usage of options, guys. Hedging. Hedging is used in portfolios in an uncertain situation. So if you don't really have a temperature of the market, you don't know which is going. The market is going up, down. The stock is going left, up, going sideways or whatever. So you want to call what is called hedging your bets because you're hedging your portfolio because you're uncertain on what's to come. Next, arbitrage. That's the make benefit of a known arbitrage. Just like retail arbitrage, guys, all it is taking in this example, some information and using that to your advantage to make more money from that. Different than inside trading, meaning this. Let's go with an example. Neo Day just happened last weekend, and knowing the information that they were going to present, our students put a put on Neo, and we were able to run that up almost 80% because of the arbitrage, right? We knew some information that we felt that it was going to push the market one way, and we capitalized on it. And also for making money, right? Money making uses option writing and option buying. So remember, guys, you don't only have to buy options, you can sell options as well, which is referred to as option writing. Now, what are some of the types of options? We have a call, right? This is what a lot of you guys out there have already heard about. We have a call. A call is an agreement that gives the investor the right, but not the obligation, to buy a stock, bond, commodity, or other instrument at a specific price within a specific time period. You profit on a call when the underlying asset increases in price. So if you feel that the stock is going up by a certain time, you will put a call on it. Okay. Now, what is a put? A put option is an option contract giving the owner the right, but not the obligation, to sell a specific amount at an underlying security at a specific price within a specific time. This is the opposite of a call option, which gives the holder the right to buy. All right. So for a put option, you feel like the underlying stock is going to be going down in a certain amount of time, so you will put a put option on it. Now let's talk about some option styles. So we're going to talk about three of the main option styles. All right, we have European. Now this is an option that may only be exercised at expiration. What is exercise? So guys, when you're purchasing an option, all right, when you purchase an option, you're not purchasing a stock. What you're actually purchasing is a contract that holds 100 stocks, right? And then if you get exercise, meaning that the option now is exercise that you have to buy those 100 stocks, and in European style, it's only executed at expiration. Now, American, an option may be exercised on any trading day on or before expiration, right? So different from European when it only can be done at expiration. In America, we can do it at any trading day before it expires. And in Bermuda, an option may be exercised on specific dates on or before expiration. So this is how Bermuda has more little stricter guidelines on when you will be able to actually exercise that option. Now let's talk about components in options, guys. So, strike price. A strike price is the price in which a specific derivative contract can be exercised. The term is mostly used to describe options in which prices are fixed in a contract. All right. So, strike price, guys, is the price that you feel that that stock will go up to or reach in that time frame. All right. What is an option premium? It is the total cost to buy an option, which gives the holder the right but not the obligation to buy or sell that underlying financial instrument at a specific strike price. Premium, guys, is what you actually pay to get in to buy a call. So, for instance, let's say the premium is $1. All right, let's say the premium was $1 for that contract because now remember, an option contract has 100 shares. You have to multiply that premium times 100, and that will be the cost of to hold that position, which in this example would be $100. All right. Now, what is intrinsic value? Intrinsic value is primarily used in option pricing to indicate the amount of the option is in the money. All right. So your premium, guys, is made up of two parts. How do they get that premium price? It's made of intrinsic value and extrinsic value. All right. Intrinsic value is, as I just stated, is indicating the amount the option is in the money. So the more the option is in the money, guys, that means the more intrinsic value that it has. Okay. Now, let's talk about time value. Okay. This is the portion of the options premium that is attributed to the amount of time remaining until the expiration of the option contract. Time value, or it can be called extrinsic value. So, with longer that you hold a contract closer to its expiration date, the um, the the longer you hold a contract towards its expiration date, the less valuable that contract becomes because of time value, and also because of the next point I was going to make, time decay. Time decay is the ratio of the change in option price to the decrease time in expiration. So remember, guys, anytime you buy an option, especially a call, you have two things working against you: intrinsic value and time decay. So the longer you hold the option, those are working against you. I always contributed to like gravity, right? Gravity is always working against you, and this is exactly how time value and time decay works as well. Now let's talk about the types of option contracts. So you heard me in the last slide talk about in the money. So let's talk about that now. So in the money, guys, in the money means that a call option strike price is below the market price of the underlying asset, or the strike price of a put option is above the market price of an underlying asset. What that all that means is this, guys. Let's say you have a stock trading at $100 a share, and you pick a option that says $80. you pick a strike price that's $80. That means that option is in the money, meaning that you think the price of the $100 stock will go up, but you bought a $80 strike price, which will put it $20 in the money. So that will make it in the money. So on the flip side, let's talk about a put. Let's say the same stock is $100 and you feel that the stock will be coming down, right? It's going to be moving down very soon. So you'll put a put option, and if you want to do a put option in the money, now you will do, let's say for the same example, you'll do 120 because the stock is $100. The stock price is $100. You chose your strike price of 120, and you did a put option. So that means now that play will be in the money. Okay. Let's talk about out the money. Now, out the money is a term used to describe call options with a strike price that is higher than the market price of the underlying asset, or a put option with a strike price that is lower than the market price of the underlying asset. So just like the opposite of in the money, out the money means if we have a $100 stock, you feel that the $100 stock will be going up, so you'll make a call play on it, and now you think it's going to go to 120, so you pick the strike price at 120. So that means now you're out the money, but without the money plays, your premium is much lower because of intrinsic value. Remember, guys, that I talked about that in the last slide. Now, what is in the money? In the money means that the option strike price is below the market price of the underlying. Is at the identical price of the underlying asset, right? So the stock is 100, you pick a strike price that's 100, that means it's at the money. Okay. Now let's break down the type of option contracts once again. So let's talk about in the money plays. If you're doing an in the money play and it's a call option, that means the spot price is greater than the strike price, meaning the price of the stock is greater than the strike price. And if it's the put, is actually the opposite. The strike price is less than the spot price is less than the strike price. At the money, everything is equal all the way around, call and put options. Out the money, when you're doing a call option, the stock price or spot price is less than the strike price, and in a put option, the spot price is greater than the strike price. Now let's talk about some risk. Options have limited risk and unlimited profit, and we'll get to that in a second. Options have limited risk and unlimited profit. And why people write and sell options? Why do people write and sell options? The reason why they do so is to keep the benefit of the premium paid for the option. So guys, when you actually sell an option, you get to keep that premium. And if that option expires worthless, then you profit all the premium there. So let's say you're doing a call option, right? That means you, the investor, expects the price will go up. Hence, you buy either a stock or a call option of a stock. Put option buying. Investor expects the price will go down. Hence, he or she buys a call option, a put option, that's a typo, put option on a stock, or they actually sell their stock. Now let's go over some simple option strategies. When you're doing a long call, guys, a long call, what you're doing is you want to buy the call options because you feel bullish. You feel that underlying asset will be going up. If you do a short call, guys, that means you are selling the call options because you are bearish on that market. A long put, guys, you will be buying put options because you're bearish as well. And a short put means you'll be selling put options because you're bullish. For you out there who don't know what bullish and bearish means, being bullish means you think the market is going to go up, and being bearish means you think the market will be going down. Now, let's look at some of the look at a long put and a short put, guys. So as you can see with the long put, you have something called a break-even point. All right. So as you can see here, the underlying stock, let's say, is $0, right? That's your break-even point. So anything above zero, you'll be in the money. You'll be in profit. Anything under, you'll be at a loss. Now, because you're doing a long put, this allows you only to have a certain amount of loss. You only can lose a certain amount with and as you see on the flip side of that chart, that's unlimited profit you can gain from that. Now let's look at a short put, right? As you can see again, you have a break even point. You also can see what the strike price is, all right? Now, as the same thing with the long put, but just the opposite, where now if that is actually going up because you're feeling bullish on it, now you're going to be in the profit. All right. Now let's go over our option strategy summary. Okay. Strategy: you have a long call, you want to make a long call. That means you are bullish and you feel that's going to be an uptrend, and the profit can be unlimited for that, and your loss is limited to just what you put in. A short call, you feel that the market is bearish and a downtrend is coming, and your profit is limited because you are selling, right? But your loss is unlimited because there's no telling on where that price could go, right? Long put means you're bearish and you feel like it's a downtrend as well, and that's how it comes with unlimited profit but limited loss. A short put, you feel is bullish, the market is going up, but you only can make a certain amount of money off these type of trades, and your loss again is unlimited with that short put. Now, last but not least, guys, I wanted to touch on the Greeks, the big five Greeks. I'll be doing going more in a deep dive on these in future videos, but I wanted to touch on them just for this basic video here. So let's talk about Delta. Delta is the change in option price due to the change in spot price. So, guys, Delta, as I said before, is the change due to the change in spot price, the stock price. So, for instance, your delta could be 0.50, right? And let's say a $100 stock goes to 101. That delta is telling you that because the price changed $1, your option actually changed by 50 cents. So you made 50 cents. Let's say you made a call and it went up $1 and the delta was 0.50. Now you made 50 cents on that movement. Now, what is gamma? Gamma is the change in option price due to the change in delta. So it's correlated directly with delta, right? Vega is the change in option price due to the change in volatility, right? The more volatile a stock is, the higher your Vega is going to be. Theta is the change in option price due to time expiration, right? So based off when your contract actually expires, all right? And rho is the change in option price due to interest rate versus your spot price. And as I said, guys, I just want to introduce you to the Greeks. I didn't want to go into too much and how that affects pricing, but I want you to have an idea of what they are. And once again, guys, I want to thank you for joining me today on this webinar on the basics of options trading. We're going to be getting into some more deep dive and more advanced strategies coming up soon in the videos. Make sure to like, subscribe, and share this video. Put in the comments what type of video you would love to see next. Make sure if you want to get 6 free stocks, make sure to click the links to Webull and Robinhood. When you join those, you get 4 free stocks from Webull and up to 2 free stocks from Robinhood as the posting of this video. Also, if you need any one-on-one coaching, the link is in the description. I want to thank everyone who joined me today. And once again, my name is Korey Rose from Your Business Needs, everyone's favorite internet entrepreneur. And until next time, peace and a share.